Hi, my name's Adam and welcome to the channel. Thanks so much for joining us today. Today we're going to be starting a brand new mini series on building your wealth through investing. And today we're going to start week 1 with understanding your investment choices. If you haven't already joined our free course, Unlocking Your Financial Health, there's a link below. Make sure to join our course. It'll help you kind of start 2021 off to a right start. It'll help you succeed in your New Year's resolutions, any goals that you have. It'll just lay out a plan for you to make sure that stuff doesn't get off track, off the rails throughout 2021. We knew 2020 was a rough year for many of you, and we want to make sure you have the steps and the action points that you need to make sure 2021 is a better year and you succeed both personally and financially. So to start off this week, we're going to go through understanding your investment choices. So there's many investment choices out there, but we want to cover off the main ones and kind of how they fit into your plan. Closer to the end of the video, we're going to go through 5 things that you need to consider when implementing your investment choices. So even though you've chosen where you want to invest, whether it's stocks or real estate or savings, whatever it is, you need to know how to implement that. And also if the implementation is the best method to go, if it fits into your overall risk and portfolio and financial and retirement plan. So stay tuned for that. Near the end of the video, we're going to go through the 5 things to consider when implementing these investment choices that we're going to go over. So the first choice you have is the slow and steady. And this could be anything from a checking or savings account at your bank to a high interest savings account to bonds. So checking or savings account right now are going to pay you, checkings is probably 0 at your bank. A savings account maybe 0.1%. Interest rates are so low right now that even in a savings account, there's no savings there. You're never going to keep up with inflation. The better option if you want safe money is to move to a high interest savings account. Again, your bank may be offering a bit of a higher rate, but it's probably not more than 0.3, 0.4% right now. Going forward, as interest rates climb over the years, it will bump up with the prime interest rate, but savings accounts are still quite low. Look for an alternative option on the high interest savings account, and this is probably going to be outside of your bank. We personally highly recommend EQ Bank. It's an online bank and they offer some of, if not the highest high interest savings account rate in Canada. So right now they're at 1.5%, which is much, much higher than the bank's offering. So take a look at EQ Bank. We'll put a link below if you want to sign up for EQ Bank. It's quick and easy. I've done it myself. I have money invested there in a high interest savings account for my emergency money. And it's a great place. I'm getting the best return, even though it's not a high return at 1.5%. It's still much better than anywhere else was offering me. Most of us have some sort of short-term or emergency savings put aside. So it is important to get as high as a rate as you can. And again, it's more about safety than return. I understand that. But if you can earn 1.5% versus 0.3%, it does make a difference. So try and find the best rate you can. Again, we've done our research. We have found that EQ Bank offers the best. There's other banks, whether it's Tangerine, Manulife Bank, some of these online banks that will offer promotional rates, which might be a bit higher, but they're short-term rates. So Manulife Bank currently right now has a promotion on, and I think it's about 3%. But it's only for 2 months. So after 2 months, it's going to drop back down to, I think it's 0.3%. So you have to look at if it's a bit of a longer term, even a year or two, that you're going to have that savings there. Maybe a bit of a lower rate at 1.5 is better than taking a 3 and then having it drop off. So just pay attention to the promotional rates and how long they actually last. The last part to the slow and steady is bonds. And bonds have really been slow and steady, but there are risks to bonds that a lot of people don't understand. Okay, so as interest rates will rise, bond prices will fall. And we're at historical low interest rates. They only can go up from here. So as they go up, bond prices will fall. So there is potential for loss in a bond. Bond is not a guaranteed investment. So just be aware of that. If you're getting invested in bonds, reach out to a professional that understands bonds, how they can fit into your portfolio. And there's different types of bonds you can buy. You can buy corporate bonds. You can buy government bonds. You can buy, there's many different, there's high yield, there's many bonds out there. So be aware, talk to a professional. We don't specialize in that. We hire professionals for our clients that know bonds very well. And so we rely on those firms to help our clients out when investing in bonds. But be aware, bonds can lose money and have lost money over the last few years if you've been in the wrong space, like a municipal bond. The next option you have on investment choices would be ownership vehicles. And what I mean by ownership vehicles is something that you actually own. So it could be stock or real estate or gold or whatever it is. So let me break that down. So the first one would be stocks. The benefit of stocks is that you can diversify a portfolio of stocks and actually create like a nice investment portfolio of many different stocks across the nation, really. You can invest in stocks both locally, globally, internationally, everywhere. Fairly easy nowadays. And a lot of North American stocks, for instance, would be heavily exposed to the global market. So if you take a company like Johnson & Johnson, they're a US-based company, but they do business everywhere. Apple sells phones almost everywhere. So even though they're a North American or a US-based company, it doesn't mean that a lot of their revenue and business doesn't drive outside of the US. In most cases, on these larger global companies, a lot of their revenue is driven from outside of where their home base is. Obviously, when we look at stock picking, it's not easy to do. And a lot of us will follow right now, GameStop. As I record this, GameStop has gone from $4 to over $400. When I started recording this, GameStop was over $400. I just checked recently, it was at $260. So picking the right and wrong stock can be costly, and a lot of people will just jump into what they see in the news. So be very aware. Stock picking is, people go to school for many years to learn how to analyze and pick stocks. So if you're gonna go out and just start buying random stocks, good luck, best of luck to you, because you're probably not gonna have much success. There are ways to get invested in stocks with not having to know a lot. So ETFs have been a mainstay for the last few years. And an ETF is basically buying a portfolio or buying a group of companies within a certain sector. So you could buy the ETF for the Canadian stock market, and buying that one ETF, you're basically buying the whole stock market. So if the stock market goes up 2%, your portfolio will go up too. If it goes down 2, it'll go down. So it just follows the stock market. So that's a good way to kind of get your toes into the stock market. And a lot of the online, whether it's your banks or like a Wealthsimple, they use ETF portfolios to manage client assets nowadays. The benefit with ETF portfolio is low cost, it's simple to do, and again, you have to buy one ETF to get exposure to many companies. So it's a nice way to kind of dip your toe into the market. The other way to buy stocks, and this is what I do and this is what we recommend for our clients, is to hire a professional money manager. The cost is very low, and they have a team around them that know how to analyze and choose the best stocks based on your risk, diversification, and just figuring out where the market's going, where it's come from, and picking the right stocks to make sure that it meets your investment risk, your retirement and financial goals and all of that. So we highly recommend, paying a small price to have your money professionally managed. We will manage, our firm manages client assets if you have $250,000 more. So that's always an option. If you're in Canada, you're not sure where to get going, or you're looking for a professional money manager and you have that $250,000 more, you can reach out to us so we can point you in the right directions. We'd love to help you out. But if you're below that 250, you can still look. There's money managers out there, there's active money managers out there that do a great job, or look at the ETF option as well. At the end of the day, owning stocks is great because you own part of companies. Maybe they're companies that you really like. So a lot of the books I've read, how do you get started picking stocks? A lot of people say, find companies that you like to work with and do business with and buy those stocks. So it could be McDonald's, it could be Nike, it could be Tesla, it could be whatever. Find companies that you like and invest in those. And I have some friends that have had great success in that. There's obviously risk to that. If you buy Tesla right now, it may be overvalued. I don't know, but it's had a great run. Is it going to continue? We don't know, but be aware that just because you're investing in a company that you think is great and that is doing well, it doesn't mean that their stock price is going to continue to climb. So be aware of that. Another ownership vehicle would be real estate. And we're gonna go over real estate in way more detail in week 4 of this mini-series. So I'm not gonna touch on it any further here, but real estate would be another ownership vehicle that you could use to grow your wealth and build a retirement income stream over time. The third ownership vehicle that I'm going to go through is small business. And what I mean by this is your business. So you're investing in yourself, in your business, and growing your own brand. So I know for myself, this is where my main investment goes, is back into Parallel Wealth, into our company. Whether it's through marketing, building our client base, giving back to our current clients, bringing in software, staff, all that kind of stuff. We put a lot of our money back into the company. That's my greatest investment. But it's also the place I've seen the greatest return. So if you own a company, sometimes that is the best investment. You need to have an end goal. You need to set those 1, 3, 5, 10-year goals so that the money that you're investing, you know why you're investing it. You can see an ROI. Make sure to track every ROI of dollar you put into your company, okay? If you go out there and buy a stock, you watch that stock if you've made or lost money. So if you're investing money in your company, you kind of have to treat it the same. You know, is that $1,500 of marketing dollars, is it being used? Are you getting an ROI on it? Can you better spend it next year? How did that investment turn out? Make sure you're tracking the money that you're putting back into your company, because if it's not giving you a good ROI, maybe your money is better put elsewhere. I will say that the clients that we work with, for most of them, their best ROI on investment is in their own business. So our clients that own small businesses, the money they put back into their business has given them the best return by far versus anything else, whether it's real estate, whether it's commercial, industrial, or residential real estate, or buying in the stock market. Investing back into their own company has always been the best ROI. That said, you want to diversify a bit, and I'll get over that in a second. So we've gone over the slow and steady and the ownership vehicles. Now I want to go through some alternative options that you can have for investing. So the first one and the most mainstream one right now is Bitcoin or cryptocurrency. So this is definitely an alternative option. I did a video a couple of weeks ago on crypto. You can go through that. It's on Bitcoin and how that kind of fits into your retirement plan. With the lack of regulation in cryptocurrency right now, it is high risk. It's provided a great return to some people. There's others that have lost their shirt on it. It's not a long-term investment at this point as we see it. Again, it could be a good long-term investment, but with little regulation around it, there are a lot of red flags. Now that may change going forward, and in my Bitcoin video I talk about that, how it actually may be a mainstay in portfolios down the road. But right now, proceed with caution. The second alternative option would be precious metals. And this has been kind of a mainstay alternative option for many years. When the market starts to drop, investors fled to gold. And gold has historically done quite well when the stock markets have not done well. So that is one place that people fled to. In 2008, and again in 2020, people flooded to precious metals when the stock market started to drop. In 2020, gold and palladium returned 25%. Silver returned 47% in 2020, and platinum was up 10%. So you can see that the precious metals in 2020 were a great investment. The few years leading up to 2020, gold didn't do much at all. So there's going to be years where they're quite flat. They could be down a little bit. Precious metals move like the market does. They can go up, they can go down. So it's not a guaranteed investment in any matter, but they have been a good alternative investment for many years. So if you're looking for a small sliver of your portfolio to be in something outside of what you normally invest in, maybe take a look at alternative investment in silver, gold, nickel, platinum, something like that. That can kind of give you a different exposure, but be aware that it is diversification, but don't put too much into these alternative investments. So to finish off this video, I want to go through 5 things to consider when implementing these investment choices. So we've gone through a bunch of investment choices from kind of the safe, guaranteed stuff to the more alternative options. But now you've chosen, how do you actually implement those strategies? So let's go through 5 things to consider when implementing your investment choices. So number 1 is, does the risk profile of the investment match your risk profile? Okay, so if you're a very conservative investor, you don't like a lot of risk, you don't like to see your investment portfolio drop, but you've decided to throw some money in Bitcoin, that maybe doesn't match up. So maybe there's a bigger reason behind why you chose Bitcoin as part of your investment or all of your investment, but if you're a low risk investor and you're in Bitcoin, those don't match up. And there's many different examples I could give you of this, but make sure that whatever investment choice you decide to move forward with, that it actually matches your risk profile, okay? And it could be, I've decided to buy rental property, but I hate dealing with people. Well, those don't match up either. So just, again, make sure that one matches the other going forward. The second thing to consider is, have you done the research on what you're about to get into? Can you validate your purchase? So if you're gonna get into rental properties, have you done your research, where you should buy, your cash flow, your ongoing costs, your vacancy rates, all that? Have you done your research? If you're out there buying Tesla stock, What is the P ratio? What kind of dividends does it pay? How are the earnings? What does that look like? Have you done your research, or have you just kind of thrown something against the wall and hope it sticks? So make sure to validate whatever purchase, whatever investment choice you're moving forward with. The third thing to consider is, have you considered hiring a professional and the cost benefit of that? So again, for my own personal money and for our clients' money, we hire professional money managers. They know what they're doing. They have a full team of analysts. They know how to break down companies and figure out exactly what your money should be invested in. Now, we pay a small fee for that, but my opinion, and based on how the performance has been of our assets, I would say it's worth it. We pay a small fee, but the return is far greater than what I could do on my own. So for me, hiring a professional makes a lot of sense. Maybe for you it doesn't, and that's okay. But have you considered what the cost benefit is of hiring a professional to help you out with those investment choices? Something to consider. The fourth thing, and we see it all the time with clients coming on board, is, are you well diversified? Okay, and what is diversification? A lot of people think diversification is having money with a bunch of different firms or a bunch of different places. That's not necessarily the case. We have a lot of clients, they have all their assets managed through one of our portfolio managers, but that portfolio manager has diversified their assets. So the client's portfolio is well diversified in maybe 30, 40, 50 different stocks and companies. So portfolio is diversified, but some clients see it as, no, the client is not diversified because they're only with one investment shop. Okay, no, they are well diversified. So just because you're dealing with one maybe portfolio manager or investment shop, it doesn't mean you're not diversified. Just make sure your portfolio itself is kind of spread out and diversified. That's what you need to focus on. So taking a step back at your investment choices, are you well diversified? Are you in a bunch of different stocks or different real estate markets, or a bit of real estate and a bit of stocks and a bit of silver and gold or whatever it is? So make sure you're well diversified so that if one industry gets hit hard, that you're not hit hard with it. So if you're 100% gold and gold goes down 25%, that's not a risk you should be taking. Diversify your portfolio and make sure that it's well maintained and managed going forward. The other thing too, when you're diversified, if one sector has a really good year, so let's say Bitcoin, you put 5% in Bitcoin and it does really well, and now it's 20% of your portfolio, consider taking some out of Bitcoin and re-diversifying your portfolio. That's something a lot of people don't do, is rebalance their portfolio every year, maybe even twice a year. The fifth and last thing to consider, and it's a really important one, is the tax considerations of your investment. So when you choose different investment choices, they will impact your tax bill. So if you have $100,000 to invest, if you bought a stock portfolio with it, okay, as that stock portfolio grows, when you sell it, it's a capital gain. So only half of it currently is taxed in Canada. That may change going forward, but currently, if you make $10,000, only $5,000 of it is added to your income for tax purposes. If you bought a rental property with your $100,000 and it's generating ongoing cash flow, the full, let's say it generated the same $10,000 of cash flow, that would be fully taxable in your hand. So it's taxed as regular income, okay? And then kind of in between the capital gains and income or interest income is dividends. So dividends are a bit more tax preferred, not as good as capital gains currently. So when you invest, consider how the income comes back to you, how you're generating a return off of your investment and how that impacts the overall return of your investment. So if you can buy an investment that does the same in one's capital gains and one's interest income, well, the capital gains is much better because, again, only half of it's taxed. So that might be a better investment just because of the tax benefits of it. So always look at the tax benefits and the tax consequences of the different investment choices that you're looking to make. And just to ladder on to those tax implications, if you have an RRSP, a TFSA, a non-registered account, maybe a corporate account, where you hold different investments matters. And this is where hiring a professional to help you out with that will make a huge difference. Buying stocks, bonds, real estate, Bitcoin, whatever it is, in the wrong accounts could mean tens to hundreds of thousands of dollars in extra tax every year, or millions of tax over a few years that you shouldn't be paying. So make sure it's structured properly and hire a professional to make sure that they've structured that properly in place. So hire a financial planner, a portfolio manager, and a good accountant. Those are 3 people. If you have TFSA, RSP, corporate account, non-registered account, if your world's becoming more complicated, make sure you surround yourself with good, smart people that can help you implement a plan on a tax-efficient basis. Thanks so much for joining us today. Hopefully you have a better understanding of your investment choices, kind of what to look at for investment choices, kind of how they fit into the overall portfolio, how to diversify, how to look at your tax implications of where you roll out those investment choices. If you have any questions, reach out. We're always here, info@parallelwealth.com. Send us an email. We'll get back to you within 24 hours. We're happy to help you out and answer your questions for you. If you haven't subscribed to the channel, make sure to do so and click the thumbs up button. It really does help get our videos out to more people. We've been rolling with this channel for a few months now, and we see firsthand the benefit of when our videos get liked. It just gets pumped out to more people are seeing this content, and hopefully we can help more Canadians save more money, pay less tax, and get to retirement in a better position. So thanks again for joining us. Have a great day.